Welcome to part 2 of analyzing business transactions with the help of the accounting equation. In part 1, we analyzed 6 transactions for the service business Eli's Consulting. And to help us with the analysis, we used the simplified accounting equation called property equals financial interest. At the end of part 1, I showed you how the simplified accounting equation became the full accounting equation. Assets equals liabilities and owner's equity. And we were able to prepare our first financial statement, the balance sheet. I know this is quite a bit of new information. Don't overthink it though. What we're doing here is figuring out where the company spends money and for what purpose. So let's take a look at the next 6 transactions for Eli's Consulting. For these new transactions, we need 2 new categories for our accounting equation: revenue and expenses. Revenue or income is the inflow of money or other assets that results from the sale of goods or services or the use of money or services. When a sale occurs, the revenue increases assets, which is either cash for a cash sale or accounts receivable for an on-account sale, and increases owner's equity. An expense typically involves the outflow of money, the use of other assets, or the incurring of liability. Expenses cause a decrease in owner's equity. So let's look at how we record revenue for Eli's Consulting. During the month of December, Eli's Consulting earned a total of $36,000 in revenue from clients who paid cash for accounting and bookkeeping services. The customers paid cash, which means that the cash account increased and revenue also increased. So let's write $36,000 for cash, plus $36,000 for cash, and plus $36,000 for revenue. In the 7th business transaction, we had revenue from cash customers. However, Eli's Consulting has some charge account clients. These clients are allowed 30 days to pay. Amounts owed by these clients are known as accounts receivable. This is a new form of assets for the firm claims for future collection from customers. During December, Eli's Consulting earned $11,000 of revenue from charge account clients. So in this case, for the 8th transaction, Eli's Consulting hasn't received cash, but instead an IOU called accounts receivable. That means that the accounts receivable increased by $11,000 and our revenue increased by $11,000 as well. In this next transaction, Eli's Consulting received $6,000 on account from clients who owed money for services previously billed. So in this case, cash increases by $6,000 because the customers paid money to Eli's Consulting. But we aren't increasing revenue because we've already recorded the revenue. Why? Well, when we first recorded the transaction that Eli's Consulting delivered services to charge account customers, we increased accounts receivable and we increased revenue. Now that some of these charge account customers are paying us, we need to lower the IOU for these customers. And in other words, lower the accounts receivable. That means that we increase cash for $6,000 and we decrease accounts receivable. For the 10th transaction, we're going to record the salaries that Eli's Consulting paid for the accounting clerk and Sergio Sanchez. In this case, Eli's Consulting is paying out cash. In other words, the cash decreased because Eli's Consulting issued payments to the employees, and we now have more salary expenses. So let's write that into our table: minus $8,000 for cash and plus $8,000 for expenses. Our 11th transaction, Eli's Consulting issued a check for $650 to pay the utility expenses. The cash decreased by $650. and expenses increased by $650. Let's now look at our last transaction. On December 30th, Eli withdrew $5,000 in cash for personal expenses. Withdrawals are funds taken from the business by the owner for personal use. Withdrawals are not a business expense, but a decrease in owner's equity. So we decrease the cash for $5,000, and we also decrease capital by $5,000. We can now look at all of the 12 business transactions, and we can see our equation still holds true. Assets equals liabilities plus owner's equity. Each side shows $136,850. My recommendation is to write these business transactions in a notebook or in a document on your computer so that you can refer to them. There are a limited number of transactions that occur all the time, over and over again, with some variations, of course, in terms of amounts and details. However, the basic concepts are the same. So think of this as learning the vocabulary for a foreign language. There's no need to struggle with these basic transactions. Write these transactions down and refer to them as you complete your homework problems. This is what your cheat sheet might look like, and you can continue adding more information to it as we learn about debits and credits. You could also make flashcards for each of these transactions. The more you practice this information, the faster you become comfortable with most of what we cover in this course. Next step after we finish analyzing our business transaction is to prepare a standard set of financial statements. Preparing financial statements is one of the accountant's most important jobs, and each day millions of business decisions are made based on the information in financial statements, and countless of investors rely on the financial statements of publicly traded companies. Business managers and owners use the balance sheet and the income statement to control current operations and plan for future decisions and investments. Creditors, prospective investors, governmental agencies, and others are interested in the profits of the business and in the assets and equity structure. So let's look first at the income statement. The income statement shows the results of business operations for a specific period, such as a month or a quarter or a year. The income statement shows the revenue earned and the expenses of doing business. The income statement is sometimes called a profit and loss statement or a statement of income and expenses. Why do we prepare the income statement first? We will need the net income to complete the statement of owner's equity, and we will need to know the owner's equity in order to complete the balance sheet. So the income statement starts with a header section where we list the name of the business, the name of the financial statement, and the time period on the third line. And then in the body of the income statement, we list the expenses for the business and calculate the net income or profit by subtracting the expenses from the revenue. And now that we know what the net income or profit of the business is, we can prepare the statement of owner's equity. We start again with the header of the statement, which lists the name of the business, the name of the financial statement, and the time period on the third line. The statement of owner's equity reports the changes that occur in the owner's financial interest during the reporting period. In the body of the statement, we start with the beginning capital balance of $100,000, which the owner contributed to the business in November. The income or profit belongs to the owner of the business, and we list that on the next line. Let's subtract any money the owner took out of the business. We list the increase in capital on the next line, and then add the beginning capital and the increase in capital to calculate the ending capital as of December 31st, for a total of $133,350. Now we're ready to complete our financial statements with the preparation of the balance sheet. Balance sheet is a formal report of a business's financial condition as of a certain date. The balance sheet reports the assets, liabilities, and owner's equity of the business. In short, things the business owns, monies the business owes to vendors, and to the owners of the business. And just like other financial statements, we list the name of the business on line 1, followed by the name of the financial statement, balance sheet, and then on line 3, the date as of which the balance sheet was prepared, December 31st. There are several different formats of balance sheets, but here we use the format that shows all of the assets on the left side, starting with cash, accounts receivable and supplies, and then prepaid rent and equipment. We add up all of our assets and then we see we have $136,850. On the right side of the balance sheet, we list the liabilities, in this case, accounts payable of $3,500. We also list Trade and Eli Capital in the section for owner's equity, $433,350. When we add up the liabilities and owner's equity, we arrive at $136,850, and that equals our assets. So our accounting equation is true. Assets equals liabilities plus owner's equity. Now, what if it doesn't balance? In that case, you would have to find the error. The first step might be to double check that all accounts and amounts were transferred correctly. And if they were, then you'd probably go back to the table that we previously prepared and double check that the amounts balance there. When you ask accountants about some of the most commonly used phrases in accounting, does it balance probably comes in among the top 5 phrases used. And that's because the system of accounting has a built-in double check in place that the balance sheet and all transactions must balance. If it balances, you can be pretty sure that you've recorded transactions correctly. Now, in terms of the financials, this is a relatively simple set of financials. The financial statements of very large companies have much larger dollar amounts, but they follow the same concepts. And now that you're familiar with analyzing business transactions using the accounting equation, we can use these same transactions for Eli's Consulting to analyze business transactions using a tool that accountants call a T account.